Hi, everyone. Welcome to this live TV show. As usual, I will share with you my views on the market, both technically and fundamentally, as well by taking the economic calendar. But before getting into the reports, let me tell you guys, politicals are taking center stage ever since last year, and the things are, and the Forex world pretty much saying it's rolling around that. We are seeing a lot of dollar strength despite efforts from new administration to talk the currency down, right? And that's because of the developments we are having in Europe. Because not only Brexit is looming, we also have a lot of political woes going on in France and Germany. Yesterday, there were news showing that for the first time in almost 10 years, the Democrat Christian Party, which Merkel belongs to, has lost the first spot in polls towards upcoming elections, right? While on the other hand, we have Marine Le Pen leading polls in France, right? Marine Le Pen has said that she will uh, mm, move France out of the European Union, out of the euro, and fight radical Islamists as her main priorities, right? And well, I know it's too early to call, but this is surely bad news for the Union, right? Particularly with so many monetary problems, deflationary pressures, slow economic growth, and all the battle the ECB has been uh, doing for the past 4 or 5 years without, or even more, to be honest, without actual results, right? In fact, inflation has uptick in the euro area last December. There was a small light of hope, but the first we had in years, right? And Draghi, in the latest ECB meeting, uh, don't talk that this diminished the importance of that uptick in inflation because it was just one number. And of course, he's right? We need steady inflation in the euro area to confirm some growth in the region also, and therefore be a bit more confident in the union and its currency. But as things going on these days, they're going towards a failure, and it's a huge news that can affect the markets. Not today, not tomorrow, but maybe in a few years, we will see a major collapse of how the forex market works. Anyway, and in the UK, as I mentioned, we have Brexit, right? And adding to that, we are seeing that the latest macroeconomic figures released last week and at the beginning of this one are showing signs of easing of contracting economic expansion, right? Last week we had disappointing PMI figures, construction, markets, manufacturing, services, right? Somehow business are not so willing to work in the current environment. And today, and you can see it in the macroeconomic calendar, right? The BRC like sales fell, right? And housing prices also fell in the 3 months to January, all of which is telling us that somehow, higher inflation is weighing on investors' mood, right? In consumption mood, right? So, having said that, we are in a tug of war in the forex and the currency markets, and well, let's see what we get from here. But anyway, let me scroll down my calendar to see what's next. Here it is. The Halifax house price index in the UK fell 9% in January, and prices were far lower than the previous quarter in the 3 months to January, right? For the upcoming session today, we have a little US data. In fact, we had lots of it last week, right? And some data coming from Canada, which I don't know if it could be relevant because, as you can see, the Canadian dollar is trading mostly on oil and Trump. So beware of that. Anyway, and given the ongoing Canadian dollar weakness, if this data disappoints the market, will only fuel the ongoing trend, okay? I don't see much to take care of for the rest of the day. with attention focusing tomorrow in the Reserve Bank of New Zealand rate decision. We don't have much data to take care of in the US or Europe. As I always said, the news from coming from New Zealand hardly affect the rest of the world. I do believe that I said this last week when there was another employment figures in the country. I have just once see this kind of this country's data affecting the world market, and that was a long way ago, in over 15 years of being within the Forex market. So it could affect, of course, the Kiwi. It could affect the Aussie, right? But not much more. On Thursday, the minor readings are also going to be released in Europe. Trade balance in Germany, and this kind of data we have from Greeks and Portugal that hardly moves the market, but somehow all of these figures, right, that may not trigger an immediate reaction in the market, will tell us about the health of the European Union. Okay, in the US, there's not much. Also, we have weekly unemployment claims, and Fed bullets will be much more relevant than wholesale inventories. Okay. And on Friday, I do believe that attention will center in China. The trade balance, import-export figures, both in yuans and dollars, will be key because there have been tepid signs of recovery in the Chinese economy. Really soft one, okay, but they are right after almost a year with the world thinking that the country was accelerating its economic slowdown and therefore will affect the rest of the economy. Last month figures, right, and December figures, I mean, were pretty encouraging, right, showing large imports of mostly base metals, right? That's what helped the Aussie bounce as much as it did. And Australian trade balance confirmed it, all right, with rising exports and a surplus of record heights post last month. But anyway, beware of Chinese data because positive data will encourage risk appetite, right, and therefore put the greenback and the yen under selling pressure. Also, yesterday we had the Reserve Bank of Australia meeting, right? They left rates on hold, and it seems like they are not willing to move rates anytime soon, right? And the market's starting to speculate about the possibility of the upcoming movement being towards the upside, right? It's still too early, another call, but the policy statement that will be released on Friday will also include forecasts of inflation and growth. So take a look at that figures, because if inflation and growth forecasts are revisited to the upside, then we will probably get a sharper, stronger Aussie, okay? And attention will then focus towards the pound and industrial production and manufacturing figures. I do believe these ones are much more relevant than the trade balance. If we have another soft outcome in here, the probability is that the pound will be nearing 120 by the end of the week, or probably early next one. The rest are not really much relevant, but the payroll in Canada, right, that will of course affect CAD, but not much the rest of the market. Okay. Anyway, let me jump towards the technical. It's a quite light week from the macroeconomic point of view, at least from technical releases, but from macroeconomic releases, sorry. But beware of what I'm saying, political news, political headlines, a party losing ground, a party winning ground, and not to mention Trump's executive orders, okay, will continue to take center stage and determine whether currencies are going these days. Anyway, let's go to the euro dollar. This is the November-January decline. As you can see, the pair corrected up to the 50% of that level. 820, it's the Fibonacci, 828 is the high. And furthermore, as I have mentioned multiple times, in between 800 and 840, we have plenty of daily lows between early 2015 and October 2016, or almost 2 years with the pair bottoming around that level. So it will be a really tough resistance to break, right? It won't be easy for the euro dollar to regain that 800, 840 region. So I do believe that at this point, it's still worth trying to sell when approaches to that level, okay? Because moreover, of course, if European data continues to be soft from the political side, right? It's too much risk to hold the euros when we are talking about the possibility of the euro area disintegrating, not tomorrow, not next month, but in a couple of years. Anyway, and the dollar is always the dollar, right? Anyway, the pair has been finding support around the 38.2% retracement of the same decline last week, but all of a sudden we have a break lower today. Watch this daily chart. We have also broke below the 100 simple moving average, which is the blue one, and the 20 simple moving average, which is the red one, right? So the level is now a major resistance, and it will take a clear recovery beyond it to deny a bearish continuation, okay? As you can see, this low we got today, 660, 650, has proved strong in the past. We have multiple daily heights and lows from the past couple of months. So we need to break below that level to see the decline extended to first short term, right, towards 620, which is this low for late January, and farther towards 565, which for me it's also support, not only because being a FIBO, but because the pair was unable to clearly break below above it. Once it was below, it had a huge struggle to recover above it. This is like a line in the sand, you know. If a pair breaks below this level, then the risk of a further declines and a retest of this 340 record low and even lower lows come at sight. I can't believe I'm saying that, but it's true. It's what I can see right now in the Forex market, okay? Above that 700, 710, we have a major resistance around 760, 770, where the pair has been rejected one way or the other multiple times over the past couple of weeks. So I do believe that we need to settle above 70 to start thinking about the probable upward extension up to that 800, 840 region, which we mentioned right before, okay? And for the pound, we have a major break lower today. As I said, poor inflation, poor sales data and poor housing prices, right? It's telling us that the consumer in the United Kingdom, it's beginning to worry about what's going on with inflation and the Brexit. And that's really bad news for the UK. Anyway, as you can see, the pair corrected by the PIP to the 50% retracement of the January, early February rally, right? The one triggered after Prime Minister May, right, announced the Brexit. Her Brexit strategy confirmed we are going for a hard Brexit and so on. What we can see in the 4-hour charts is the price is back below this 200 exponential moving average, converging with this Fibonacci resistance. And at 24.30, we are still quite close to the level. So I'm thinking, oh, well, it's a definitive breakout. But as long as below this level, I would favor downside. And of course, lower lows will probably signal a steeper decline, sorry. We have 23.30, in fact, a few pips below the Fibonacci support as the critical level to watch because the pair has stalled around it multiple times. 23.30, sorry, I moved my mouse. That's the key, you know, if the pair ends the day today below 133.30, there's scope for further declines. Of course, the next support will be this 22.50, 22.60, 70 region, and below that last, I don't see much in the way towards 120, okay? If somehow the pair manages to regain 24.30, then we have scope to recover towards the 24.90, 25 region, but things get blurry in between this level and 25.40, right? So once the pair recovers up to here, up to 25, it can turn back south or it can break higher, we don't know. taking profits and wait and see if it regains its Fibonacci area. Then 126 comes next, right? USD was affected, as I said, by the Reserve Bank of Australia decision to keep its rates on hold, right? I do believe that we have been on hold for last month or so after the Reserve Bank of Australia cut rates to record lows of 1.5%. The latest Melbourne Institute inflation reading, right? It was quite tepid, so that's also weighing on the pair. Besides, I do believe that discussed multiple times the fact that the pair beyond 77 will put the Reserve Bank of Australia in an uncomfortable spot, right? So I guess that at this point, the market is not willing to push the prices much more higher. Anyway, let me share with you this weekly chart, right? The pair has failed multiple times during the second half of 2016 to settle above that 77 level. We have a spike. This is a weekly. If you put a daily, you will see that the tips were far a lot, right? And we have this high for 2016 from April at 78.34, right? So if somehow the pair can stabilize above 77, that will become a probable bullish target, which is 200 pips from current levels, so not that far away. But remember, above 77, both the Reserve Bank of Australia and some speculative interest is uncomfortable. So I'm not really seeing a clear breakout of the level at this point, particularly because the soft tone we are having in equities and ongoing dollar strength. However, beware of what I said earlier about the Chinese trade balance that was going to be released this week. And take a look at base metals such as silver, gold, copper, iron ore, because if those keep holding on to gains and recovering ground and rising, then the OC will find in them support, and therefore there's a good chance it will go higher, okay? So far, the pair is holding about 76. We have relevant heights, relevant rows in the region. So I would say that below 75.90, right, confirming the break of the 76 level, the pair can go lower, okay? But still, I don't see it falling much, right? 75, 40, 75, it's a support area. So down to that level, it will take a real dollar strength, which we are not seeing right now, right? To see the pair breaking below the level, in which case the next support is 34.50, but still, I don't believe that will take place anytime soon, okay? The dollar Japanese yen, well, guys, what can you say? The pair is clearly bearish as of lately, ever since setting that double top around 1880. Honestly, falling equities, falling yields are helping the yen to gain ground so far, compared with other mayors, and in the short term has posed the tepid recovery in dollar Japanese yen, which means that investors are still looking to sell this particular pair. But it reached Mayer support and Mayer bearish target, which is 1160. In fact, I believe it traded as low as 1158 today, which is the 100 simple moving average in the daily chart, right? You can see how the pair today bounced active from the level and recovered the 12th level, but still looking bearish, still lower highs, lower lows, and too close to that Fibonacci support around 12 to think about further recoveries. And maybe this break above this 1360 region from previous heights, can see the pair recovering further. But to be honest, I believe that upward moves are seen as opportunities to sell as long as below 1450, okay, which is the next Fibonacci resistance. If by going back to daily charts, somehow we lost that 1150, 1160 price zone, daily close below the 100 moving average, not a couple of pips, and a bit more, and further declines, then the pair can go back to 110. I have the 50% retracement of the latest bullish round at 109.92, as you can see. So that's what I'm thinking of, 110 as a probable bearish target. Okay. Gold prices have recovered up to the 50% retracement of the post-US election slide, right? As you can see, this is a climb we have, the spike we got, sorry, once Trump won the elections, the low post in December, and here we are, we reached the 50%. I believe we discussed the probability of the commodity, sorry, trading around 1230. The technical readings, right, are mixed because technical indicators in the daily chart are losing momentum towards the upside, and in fact, the momentum indicator is clearly diverging, right, from price action. We have an upward trend in here and a bearish one in here with lower heights and about to break below 100. And okay, the RSI is retreating from oversold readings, so in general, the technical indicators are telling me that the risk has turned towards downside, but at the same time, we have the price above the 20 and the 100 simple moving average, with the shortest crossing above the largest. So that's generally a bullish sign. Okay. So quite mixed outlook, and the price stack around the feeble level. I would like to see some follow through, right, above 36, right, beyond the heights we set here and mid-November, to think or consider an upward extension up towards the next Fibonacci resistance, which is 55. So a stronger dollar will prevent gold from rising that much. And if somehow we get signs from the Fed that are hawkish, then rally will probably reverse and we'll see the commodity falling back. 2004, in fact, is the Fibonacci support. 2007, we have the moving averages. So in the case of a sudden slide, that level should hold, right, for now, until we have more relevant news or more clear signs of what the Fed is thinking or will do during the upcoming months. Okay. And finally, I will take a look at crude, but honestly, there's not much to report in here. I was taking a look at the daily chart, and we are clearly stuck in a range between 52 and 54, right, with a couple of spikes either side, but unsustainable ever since 2 weeks ago, right? We have opposite market news, as I commented on the previous update. We have the OPEC fulfilling the output cut. They plan to take prices higher, but at the same time, we have U.S. production rising at a really fast pace, right? U.S. stockpiles increase. We will get that about it today and tomorrow, so keep an eye on it. More drilling rigs. Overall, the market is uncertain of where to go. I believe it's quite a comfort zone what we got, and that the pair will probably continue trading between 50, 55, right? 50, 55 range would probably persist. So approaches to the high will favor sells, approaches to the bottom will favor buys, unless we have really disappointing news. Not seeing much directional strength going on. Daily charts, as you can see, we have indicators flat around the midnights. And in the short term, the situation is even worse because take a look at moving average, right? 20 moving average, 100 moving average, 200 moving average, all together, mix it up, moving back and forth in a tight range. That is clearly a sign of absence of trend, okay? So when this three moving average get this way, it's clear that there's no certain direction and therefore no clear trade. Technical indicators are in negative territory, so pretty much the risk has turned towards downside, but honestly not feeling much comfortable about price behavior, and I'd rather keep on playing within the range if I have to choose. Okay, anyway guys, that's it for today. Thank you for being here, from sharing this time with me. Okay, here we are. Sorry, a bit slow reaction from the Hangout. Thank you and see you next week. Okay, bye bye. See you soon.